Hi, friends. Welcome to the webinar. Sorry for the short notice, and also because there's just quite a lot I wanted to cover. So I was just getting all the last set of slides done. So apologies, I always seem to be late. I know it's just because there's just so much to get done, and I've got to squeeze it into my schedule. So you should be able to see the screen over there. We will have ample time for talks and everything else. Hello, Ben, Parimal, Jagdeep, Kavita, and everybody else. We have Paul, Jonathan, Roland. Let me know where you're from. If you see me looking off camera, it's because I've got other screens up. Speaking of which, let's make sure you can all see and hear me loud and clear. Please let me know that you can. Whoops. Quick reminder, not a solicitation to buy or sell any individual security, and it is not financial advice because I don't know you and I'm not speaking to you individually. So let's start off with AI, and then we're going to go into individual stocks that I happen to like, but more importantly, portfolios and the way to construct them. So you're hearing a lot about AI, and everyone's starting to get worried that is it going to mean that you're about to lose jobs? Well, we're seeing certainly companies with immense amounts of increase in profitability. Now, that could be because they're laying off some of the workforce. It could be simply because the existing workforce is more productive, or it could be a combination of both. And like with any change in business, whether it's AI or anything else, you will get some losers. You always do. That's the nature of competition. The point of competition, whether it's caused by AI or anything else, is for me to beat everybody else that I'm competing with. So it's as if some people are suddenly thinking, oh my God, there might be some layoffs. There have always been layoffs, whatever the technology, whether it was the steam engine, the combustible engine, the horsewhip. Okay, so that sort of what really is panicking people is it going to be sudden? And is it going to be large in size? So speed and scale are always the things, whatever it is, whether it's unemployment, stock market crashes, personal life. Speed and scale, that's what worries people. That's what leads to panic. Something happens fast and it happens big. We're more worried than something small over a long period of time. And we essentially don't know. But what I do know, and this is the message I want to get across to you, is we want the kinds of companies which have a track record, because we're hiring these companies to manage our retirement, that have a track record of doing rather well for us. And in order to find those, we're going to, as you know, go through 10,000 companies. None of these that I'm showing you on screen will meet our criteria, because out of 10,000, we want to pick probably the best 200 as a shortlist. And from those 200, 20 to 40 to go into our portfolio equal weighted. Keeping it simple. You don't need more time. You need fewer decisions. And that's how we do it. Making sure they're undervalued, high growth, dividend yielding, cash flow producing, good strong momentum, good average returns, and a track record of so, and the kind that the market likes to buy every time they fall. In other words, what's called a high sortino. So let's dive into some of that and put to rest that whatever happens with AI, our job is not to predict it. If it was, we'd be the CEO of Meta, Microsoft, Apple, Amazon, Alphabet, Costco, JP Morgan, Goldman Sachs, Warner Brothers. Our job is to hire the right team, most likely to navigate that and do one thing that all listed companies are hired to do, which is make the stock price go up. That is their sole responsibility. Make the stock price go up. Okay? Their job isn't to be nice environmentalists or anything else. It is make that stock price go up. That is what a board of directors is charged with. That is their corporate duty. If they fail in that through negligence, they will be sued. If they fail in polluting, yeah, they might be sued, but it's secondary. All the other do-gooding stuff, the diversity metrics, the environment, that's secondary. Make the stock price go up is the sole reason shareholders list a company on the stock market, and that's what they expect the board of directors to be able to deliver, and is their legal duty to do so within the limits of the law, right? So we're hiring them to do that for us. In order to find the best companies to do that, we want to make sure that they're not overvalued. In other words, they have very poor earnings. We want to make sure they don't have poor earnings. We want to make sure they've got strong cash flow. We want to make sure the balance sheet is strong, the profit and loss account is strong, the cash flow is strong. They've got good, strong momentum. They've got a track record of high returns and delivering those, and very shallow falls, and preferably not too much volatility either, because our ulcers don't like it. Then we want to mix up those companies so that they're not highly correlated. They don't all move in lockstep, also known as they're diversified. That correlation number is what gives diversification, not this. That doesn't. Oh, they're in different sectors, Alpesh, different countries. Okay, there you go. They're in different bloody countries. So what? So what? Oh, they're in different sectors. Oh, they're diversified. Well, that's a pretty shitty way of working out diversification. Okay, statistics. Diversification is a statistical mathematical measure. So why don't you look at the bloody maths? It's very simple. Okay, it's just that people confuse it. That's actually the bigger problem, right? So that's your AI issue down there and what's happening with AI in terms of workforce. Am I worried? No, because it's not my job to worry. The old Apple saying, you don't buy a dog and then bark yourself. It's not my job to worry. I've hired somebody else to do the worrying for me. His name's Tim Cook, for instance. His name's the CEO of Goldman Sachs, for instance. So are we in a bubble? Again, it's not a worry for me. And I'll tell you why, because in a moment when we go and look at the individual stocks we're going to look at, which I'm going to show you in a second, and the market as a whole, I explain to you exactly what are the things that I look for in a, let's do it over here, in a particular security, and why, therefore, I'm not worried about, for instance, is the S&P about to fall? So I'm going to pull that up on screen and I'm going to show it to you. Okay, now I could look at all of these warning bubble signs, and you see them on screen. You can read it for yourself, and why this time might be different. Okay, and there's pros and cons, and that's the problem of looking at narratives. I'd far rather look at data. Well, let's have a look at the data. Are we in a bubble? Well, the S&P 500, the US market, is really the one which dictates the way the rest of the world goes. And where are we? We're very much looking like we were 12 months ago and like we were in January 2022. If you look at this, and this, what I want to show you in this bottom half of the graph is the medium and long-term average prices. Look at the green dotted line. Forget the blue for a moment, the green dotted line. Okay. And if you look at a bit of pattern recognition, you work out there's one of three things that can happen. Okay. The first thing that can happen is that this very simple trend just continues going upwards. All right. That's an obvious thing that can happen. And what would happen if that continues upwards? Well, here's the bullish case. And this is the case that makes us all rich and we're all very happy. We go up another 20% within the year. Okay, that's the bullish case. What's the base case? Well, that this happens as happened last year. We get a bit of a V-shaped drop, 14% drop or so this year, and then we resume upwards. And if that happens, well, we'll probably get a slower bar and we're up maybe by the end of the year, about 12%. That's your base case, because first you fall. And I'm not saying the fall's about to happen now, but let's say first you fall. Ooh, let's work out 14% first, shall we? Say you fall 14%. Okay. And then you rise. All right. So you get your 14 down first, and then you go up. Parallel, let's say roughly like that, and you go back. What are you for the year? Actually, your base case is you're pretty flat for the year. You get about a 0% return for the year. Okay, so that's your base case. Bullish case, base case. What's the bear case? The bear case is this, that you get what happened in January 2022, because the pattern looks similar, and you fall. Now, which of those three are going to happen? I don't know. Let's say you get a 24% drop from where we are now. Let me remove some of the other ones. Okay. You get a closer to a 23% drop. And if that happens, well, you get a 23% drop. And we don't know which one of those three is going to happen, bull, base, or bear. You simplify it. You can assign probabilities to it if you wish. Some of you will say it's going to be the first one. Some will say it's the second one. Some will say the third one. I don't know. What I know is each week I'll keep looking at this. And at the moment, I've only got three decisions to make: buy, hold, or sell. Well, if I'm buying, I'm going to buy in stages cautiously because markets are expensive. Am I holding? Yes, I am, because I don't have a reason to sell. Am I selling? No, because I don't have a reason to sell. Very simple. It's all about decision making, and that's how you simplified it. Okay, and I'm going to show you some more things on that, but that's exactly where we are right now at this very moment. And that is good. I am overall positive. I'm not whinging. I'm not complaining, because we're not like 2022 where the market was falling. It happens once in 7 years. Other than that, it's relatively benign, which allows my stocks to grow. And we'll look at some of those in a moment. There's another reason why I can afford to be stoic, okay, or calm, put another way. Okay, and I'll answer some of the questions a little bit. Hello from Stockholm as well. Arun, I'll answer yours later. Michael said he can't hear me. I think everybody else can hear me, can't you? Can you all hear me loud and clear, I hope, because I've just been talking for so long. It'd be a shame if nobody else can hear me. So, yeah, let me know you can all, everyone else can hear me, please. Now, let's therefore go on to the other aspects, which is how to be the, well, it looks like everyone else can. So good. And it's this, and I'm going to give you probably the single most important piece of advice anybody can ever give you. If you want to have, first of all, like I said, it's the problem of the companies to generate you a return, not yours. Secondly, so you've got to find the right companies. Secondly, think of the portfolio level, not the individual stock level. So let's say we simplified it to 20 companies, 5% in each, or 40 companies, 2.5% in each. And then however much you keep in cash, the older you are, the more you keep in cash. So you might be 100 years old, in which case 100% of your money should be in cash and nothing in the stock market. You might be 20 years old, in which case 100% should and could be in the stock market and nothing in cash. Got it? And then a sliding scale in between. And I've got some free apps which will help you work out the sliding scale as per your risk appetite in a moment. But again, it's all about simplifying the decision making. Now, if you then look at it at the portfolio level, you don't have panic attacks that an individual stock has dropped 30%. Because you're no longer trying to be perfect. You're closer to a Warren Buffett. And that gets you a hell of a lot further. The major problem private investors have is they're all trying to be hedge fund managers and try time the market perfectly, implying that they're trying to get everything right all the time. He became the world's richest man, yet never, ever in any given year did he have the biggest moving stocks, and never, ever did he have every stock in his portfolio going up. And yet private investors are trying to be even better than the world's richest man, which is ambitious, but probably says more about people's delusional egotism than it does about reality. So you have your portfolio, 20 to 40 stocks, 2.5 to 5% in each, and an allocation for cash depending on age and risk profile. Simple. And then you're holding for 12 months and rebalancing every 12 months. What does rebalancing mean? Well, if let's say one stock had gone up 1 billion%, you bring it back, all of them, to the same level, 2.5%. Why? So you're not over concentrated in any one stock. But you can see why private investors make these massive mistakes. They're one of many mistakes they make. I rely on, and I've written about 3 Nobel Prize winners in particular who have done the research on all of this, and I wrote about them in my books. I wrote about in my Financial Times columns, Richard Thaler, Daniel Kahneman, Eugene Fehmer. There are others, Harry Markowitz as well, Nobel Prize winner. We'll come to some of their work. If only private investors bothered reading their work, why would you? My work, why would you? Then you'd see all of this has been worked out and sorted before. Let me put it this way, and this often confuses people as well. That's your job, investment A plus investment B. Combination of both. Guess what? Same return, less risk. Just look at that for a moment. That blows people's minds, especially if they are not familiar with mathematics. That absolutely destroys their minds. They just don't understand it. Long-term wealth is actually created by having not inversely correlated, but actually non-correlated assets put together. Harry Markowitz, Nobel Prize winner in economics. See that image? It's essentially why he got the Nobel Prize in economics. I know, it's mind-blowing. How can you have 2 risky assets which reduce the risk of the overall portfolio? You know what the mistake private investors make? Oh, my investment's not going up. Think of the red one, investment B. It's not going up. I think I'll get rid of it because it's risky and poor performing. The perverse thing that then happens is they're left with only investment A, which ironically, by removing investment B, which indeed was performing poorly and was risky, i.e. it was volatile, i.e. it moves up and down and not in a straight line, they ended up with only investment A, which is equally volatile and just at the point where investment A starts collapsing and falling. And then they get out of investment A at the bottom and they end up not with the return, but with the volatility taking more risk, perversely, without realizing that by removing a risky asset, you're actually taking on more risk. I know, it's mind-blowing, isn't it? It doesn't make sense. How can Alpesh, if I have two risky things, I'm having less risk? And how by removing one of the risky things, am I left with something which is more risky and I'm more likely to psychologically mess up? There you go. There's the image and there's the picture. And if he hadn't got the Nobel Prize for it, and if I'd just told you this, I would have got it. Okay. And that's our job when we're constructing portfolios. So when we put these things together, and this is the bit people don't understand, one of the psychological reasons to look at a portfolio and not just one stock is because you never know which one's going to do well. But this is why the idiotic people on social media who go, get this tip sheet. Oh, they've now tipped this company and they've tipped that company and the newsletter and all the rest of it. So off, well, they always mess up. They mess up because they'll focus on the ones that they accidentally got right. But actually, they should be looking at a portfolio as a whole and the correlations in between, not least of which, because they're trying to sell you a subscription, they're always trading in and out, adding new ones, removing old ones. Well, transaction costs, anyone? Guesswork, survivorship bias. So they're only showing you the ones which are in there and all the losses have been magically wiped off. So there's the correlations, and you want those actually to be as close to zero as you can get it if you can. But don't worry, that's pretty tricky, but we try and do that. Which is why, because that's tricky, people then resort to just simply trying to guess based on sectors or countries. And so, well, that's Vietnamese, that's Chinese. I'm sure that's not linked to anything that's happening in America. Are you kidding? When the markets fall, everything gets correlated to the downside. Then you can think at a good, solid portfolio. Now, this seems tricky, and at this point, you think, oh, I'll just give it to a pension fund manager. Well, they're really going to mess it up, as I'll explain to you in a second. This is why we do it. Now, I don't know what the growth is going to be, and it certainly won't look like this. It won't be 20% per annum. It's not a bank account. Some years, the markets will do really well, and you might get 40% because you did really well, you got lucky. Other years, the market crashes like 2022, and you end up with nothing because you're having to hold cash. Okay, but that's the idea. Today happens to be my son's birthday. And the idea is with these tiny little ISA, because there's only tiny sums you can put in an ISA because governments don't like people saving too much money outside of the tax regime. Indeed, they will soon nationalize your pensions as well and control where the money goes. And they're moving in that direction, as you can tell already with ISAs and controlling where your money's going to go. Because it's just too much money to leave alone. They're the sort of Robert Maxwell at government level. They want their hands on your pension. So what happens? You go from 0 to 8. Now he's 8. That's the capital contributions because there's only so much you can put in. I mean, it's more than that because you can put in more than that by now. But that's the idea. Now it starts. Now, people who've been following me will know since he was born, I've been saying, well, for the first few years, it's like your growth is barely above the capital you contributed. Now it starts getting exponential. Now, when he gets 9 next year and 10 and 11, then hopefully in a year, he's making about 100,000 a year in just growth because that's how mathematics works. But guess what? Why does nobody do it? I know what you think, well, it's called compounding. I know what it is. Thanks a lot. Bye. Nobody does it because they don't understand the psychology of it. Why would you bother if for the first 7 years you got barely anything to show for it? Well, for the first 6 years, and that's at a 20% per annum growth, which certainly can't be guaranteed and would be great. I'll take that. But the markets have been good over the last 7 years since he was born. There were 2 bad years. 2022, where we had to hold cash because the markets fell, and 2018, where in the year it was born, just in the last few months, it ended up rubbish. So again, it was flat. But beyond that, we had some great years thanks to Donald Trump and Joe Biden, where the markets just soared 2023, 2024, 2025. I didn't control that. The point is, most people don't bother doing this because who the hell, psychologically as humans, we don't look 8 years ahead until it's too late and 8 years ahead means you're about to retire. But the idea is when he's getting ready for school and, leaving school and going to, become a plumber or something, at least there'll be a substantial amount. That's just, it is called compounding. I know exactly what it's called, but what people don't understand is how it becomes exponential at the end. And by the way, and we're going to look more at the markets in just a second, if you want to have a pension rating, you can put up your own pension on our free app. It's at campaignforamillion.com/tools, and we've got a pension rating, and it'll measure your pension, give you a rating A, B, C, D, or whatever, and it'll tell you what's wrong with it and why it's underperforming, and so on. You can do that. Here's another example. why it's worth doing. Let's say you've got $250,000 in a pension. You might not if you're in your 20s or 30s. You might have far more than that if you're in your 50s and 60s. A 5% improvement on what you might already be getting with an IFO, whatever, that's the additional gains. That's the additional gains. That's the additional gains. That's what I want to do. Now, these are out of my hands, and they're certainly not guaranteed. They are dependent on the market, and the stock market might never, ever go up ever again. But on the basis that things are going well in the markets, and they have been for a while, that's fine. If you think that the market's never going to go up again, and you're one of those sort of Michael Burry type miserable sods, then you shouldn't invest. Just put it all in cash, okay? Or spend it, I guess. Okay, but that's why we do it. Two very simple numbers, and these are the two things I show my wife. I show her this. I show her this. She's not, sort of financially. I wouldn't say financially literate. She just doesn't have the time for any of it. She goes, no, you do. I can't be bothered. So I show her this. This is what I'm doing. This is why I'm doing it. Just so you know what your husband's doing. Okay. Another question I'm often asked, and again, I'm going to come back to the stocks in just a second, is should we go all in or not? This is what most people do. If they're going to buy into a portfolio, whatever they're going to buy, maybe it's Microsoft, maybe it's Rolls-Royce, maybe it's British Aerospace, whatever they're going to buy as a portfolio, tranches, a third this month, a third next month, a third the month after. You can see the advantage and drawbacks of every approach. You can see it there. I'm not going to state the obvious. Read it for yourself. This one is the one most people would do, and it's probably the most sensible. Hindsight would tell us which one of these four is going to be winning in any given year. But that's hindsight. Don't have a crystal ball or time machine. So what happens is, mathematically, that works out pretty good. This one is from, I think, JP Morgan I got this from. Very simple. For bonds and cash, just read cash. So, bank account giving you about 4%. Bonds just means fixed term interest, high interest paying savings account. You're not going to buy bonds through the bond market directly. Don't even think about it. You'll mess it up, because even bond portfolio people mess it up. So don't. Just put it at 4%, because that's what the bonds are going to give you anyway. Okay, and there's your stocks. Right, very simple. Conservative, very old, maybe 70 years old. Aggressive, in your 20s, 30s, 40s. Okay, that's still me. I'm in my 50s, and I'm still what they call aggressive. I don't think it's aggressive, because I know what the hell I'm doing. I'm going to give you some stock ideas, okay, some thoughts, but I want you to think portfolio level, and we're looking at AI again. Well, we're looking at AI. And one of the things I give my clients, I can't give you this, but I'm going to give you one or two examples, is this. We might look at what the biggest banks are happening to say as buy recommendations for their wealthiest clients. Now, that's not because we care what those banks are saying for their wealthiest clients. It's because we're trying to narrow down from this list. Once we've got it all green, okay, from our 10,000 down to 200, we're then trying to narrow down, okay, which hit our value growth income 7, 8, 9, or 10, which are all green on our cash return on capital invested. So which are all green, and which of Goldman Sachs just upgraded for their richest clients. So it's a way of narrowing down, all right? Because you're still down to 200, 10,000 down to 200. So we narrow down. And most people quite like that way of narrowing down. JP Morgan Private Bank have just said buy this or buy that, etc. Everything, by the way, that I've told you, I used to lecture on as a visiting fellow at Oxford as well. So, and it's all published. So this is not just bloke has just woke up one morning and thought, do you know what? I've got an idea. That wouldn't be a very sensible way of doing things. What we also do with clients to narrow it down is we might show them, well, what are the biggest hedge fund managers who have got at least $1 billion in assets, at least 40% returns for the last 3 years running, okay? What stocks do they like at the moment in their portfolios? So we narrow that list down. So we start off with our own list. We'll filter ours, but then we might say, well, what do this particular hedge fund with 17 billion, which has been generating 50% per annum for the last 3 years, what do they hold? Oh, look, he holds these. Now, that doesn't mean I go out and buy it, and they've got to hold at least 5% of their money in each one of these. In anything that we look at, otherwise it's too small, it's insignificant. They've got to have at least several $1 billion, and they've got to generate 40% per annum. Now, that doesn't mean you go and buy these. What it means is, if I look at this, to give you an example of NVIDIA, okay, so with my clients, I've given them a whole table and list of these and which ones meet. So yes, it meets our value growth income 7, 8, 9, or 10. It's very much in the news and with AI. And I said this is an AI webinar, so I wanted to go through that. And can we reasonably project forward Is it reasonable? Yes, it's reasonable. It's not unreasonable to say that that would continue at that rate. Probably won't do exactly that because we know in the past it can have these drops. So, well, what if Alpesh it's going to drop? Well, I've got two options. Either I can just buy and hold through it and think portfolio level, which is what I tend to do, or I might even buy more as it drops because we know that buying on dips, so this works. The only time I probably don't want to do that is this period, 2022, where not just this stock, but all of them were showing this pattern of falling average prices, which is why if you go back to my YouTubes and so on from 2022, we held cash then. But that only happens once every 7 years. The rest of the time, it's do nothing or buy more on a dip as long as you're not over-concentrated. Very simple decision-making. Buy, hold, or sell. Do I want to buy more? Well, I'd be probably over-concentrated. Do I want to hold? Yeah. Do I want to sell? Well, not unless this and every other stock is pretty much showing that kind of pattern, which, as you can see, they're not. And I do these weekly webinars anyway to reassure you on that in any event. What private investors try and do is get it exactly right every single occasion. Now, if I look at the narrative on this, of course I can see narrative reasons never to buy any company ever. That's why we don't like narratives. We like our specific data points, which the Nobel Prize winners say are the best ones: value, growth, income. Croaky comes from Goldman Sachs Wealth Management, Sortina from the hedge fund industry. So between the hedge fund industry, Goldman Sachs, and the Nobel Prize winners, it's those data points which we know are the most important factors, not narrative and stories, which are always available to say, don't do anything. Okay. If you then look at this, and again, I shared this with my clients, no, these are not our buy list. And some of these we wouldn't want to touch with a barge pole. Okay. So what we did with our clients is we did a special report on AI because it's very much in the news. And that's a breakdown of all the types of AI. Doesn't mean we're going to buy all or even indeed any of this. Yes, it just so happens I do happen to have monolithic power, for instance, okay, but as a part of a portfolio. Now, I wish I had that and nothing else because 35% up, fantastic. And this is just year to date, okay? But I didn't because we didn't, that's why we have a portfolio, because we didn't know what would do incredibly well, or KLA or ASML, which happen to have an AMAT. I would have AMD, okay? But I wish instead, a Micron we happen to have. But guess what? Taiwan Semiconductor. But guess what? If you only bought only these, you'd be very highly skewed and very, very risky, because what you're doing is you're skewed in just one area, which is AI. And AI in directly related. So that'd be stupid. So you might have a few at 5% each or 2.5% each in those. Why not just put all your money into one basket? Put all your eggs in one basket, Alpesh. Well, I hope that answers it. So to give you one example, and by the way, there's a lot of these we don't have, and I wouldn't want to own because they don't fit our criteria. These are on there to show you all the stocks in those subsectors and industries, but they all had to meet this criteria before they hit a portfolio. So let's get that correct. It isn't because of the narrative and the story that they're in AI. It's because they happen to tick all these boxes. The fact that they then happen to be in compute and acceleration or equipment lithography and deposition for semiconductor manufacturing, that's neither here nor there. We couldn't care less. They hit the numbers first. What they do for a living, whether they make AI semiconductors or they make shoes, I couldn't care less, because they're factories for making money. They were undervalued, high growth, dividend yielding, growing companies. Okay. Not all of these. This is not our portfolio. I'm showing you all the companies. You can find it publicly if you search on Google, which are all the foundry making companies, which are all the packaging companies. That's not a portfolio. That is showing you what I showed my clients, but then we narrowed it down to what was suitable in a portfolio. That's different, which are only a few of these, because we're narrowing it down to the best of the best of the best of the best. So if we take something like Applied Materials, which I don't mind disclosing I happen to own, well, look at that volatility. Now I had two choices: either to try and time in and out, well, we're not here to trade, we hold it through. Well, if you're going to buy and hold, you better make sure you've still got value, growth, income, cash flow, Sortina, so they're good quality companies worth holding, that you can rely on them to deliver a result, even if they are falling, and you sit back and do nothing. And also you're relaxed because you only got 2.5% of your money in it, or 5%, depending on whether you got 40 stocks or 20 stocks. So you can afford to relax for that reason. The mistake private investors make is they try and time every single movement. I don't want to lose even a penny. So I'm trying to get out here, get in there, get out there, get in here. You're not traders. You're going to screw it up. What you're going to do is get out at the bottom. You're going to get in at the top, get out at the bottom in panic, and you're going to miss the upsides. Guaranteed. I will guarantee you one thing. If you try and trade and time, you will get in at the top, get out at the bottom, and miss the big moves. Those three things I guarantee you will happen to you, even in something which moves up. Therefore, Again, simplification of decision-making process. You're better off buying and holding good quality companies. How do you decide if they're good quality companies? Not because of an AI narrative or stories, but because value, growth, income, cash flow, Sortino, alpha all hit. And a lot of these, as proof shows, you might get effed up on. You might screw up because you think, oh, they're in the right sectors, I'll just get it. And guess what? You buy it at the top because they're already overvalued. AMKR, already overvalued, volatile, expensive, revenue growth not being delivered. DBRG, way too risky, incredibly volatile, not worth being into any pension. That's the danger. Even then, you mess it up. And retail clients always do the wrong thing. They think, oh, I've got the sector right, so I'll just shove it into any old crap. Then they panic. Then they buy at the top. Then they exit at the bottom. Then they miss the growth. If there is something that they could get wrong, they will get it wrong. So you might think fund managers are the best people to manage your money. No, I'm going to show you exactly why not. And like I said, with something like in Applied Materials, it's not the narrative. It was the data. Even if on a discount cash flow, and this is a very important point, this is the discount cash flow valuation. There's many ways to value a company. I don't expect you to be able to do any of that because it's more complicated. But a lot of the measures are not relevant to how stock prices move. And we know discount cash flow is not a good measure of future price movements. So be careful of all the data that's thrown at you by newsletters and talking heads. Most of that data is simply not relevant. What's relevant? Well, we know from the Nobel Prize winners and from Goldman Sachs and the hedge fund industry, the things I'm showing you there are the most relevant. So why do people use the other stuff? Well, it's the same reason they don't listen to Warren Buffett. People are people, they want to sell you something else. Applied Materials, there's some good numbers, okay. Well, wait a minute, forecast price to earnings, that's a bit expensive. Yeah, that means you're paying $35 for every future dollar of profit. So it's like buying a house. And if I say to you the house is going to generate $1 in rent a year and you pay $35 to buy the house, you might think, well, is that expensive? Well, actually, no, because guess what? The price of the house is growing. In other words, there's sales growth, revenue growth. Guess what? No, because the house next door, you're paying $50 for $1 of profit. Guess what? No, because historically, maybe it was $50 and this is now cheap. So there's a lot more to it than just, well, I'm just picking your bloody number. Okay, don't do that. So we know what's important: value, growth, income, cash flow, Sortino. And we know that 99% of things are irrelevant, including news and narrative, which is why we're relaxed. And we also know if it's fallen a bit, doesn't matter because it's only 2.5 to 5% of the portfolio, and most things go through a cycle and they recover. So we're stoic, we're calm about it all. We even know its historic dispersions, how much it can move. And if it's a company we like, we know what the buy the dip percentage drop is from the peak. This one, 42%. If it drops 42%, I might want to buy more. But if I've already invested ample in it, I might not buy more because I don't want to be overexposed to any one stock. But if I did, there's the buy the dip number, 42%. If it drops 42% from peak to trough, we know we're going to probably be in the money because it's a good company. Well, what about exchange traded funds? Surely they're diversified, so they might be a better. And we're looking at one here I want to show you, which I showed clients. And the current problem with most exchange traded funds, which are a basket of stocks, this is European momentum. If you wanted Europe exposure and momentum, this is a bloody good one. Here's the problem. If you look at the average prices, it's going at a pretty fair clip. So be careful because it can easily pull back. Is it about to? I do not know. That's why I can't put all my eggs in one basket because I don't know. Would I buy it now? Cautiously, because it's overbought in small amounts as maybe 2.5 to 5% of my portfolio. But I'd also project forward that rate of growth and make sure it's giving me at least, is that a 40% per annum rate of growth? If it isn't, then I'm sorry, it's not moving fast enough, high enough for me, which is the problem with a lot of exchange traded funds. They don't grow enough. But here's the other problem people don't appreciate. Yes, they can fall and substantially for a prolonged period of time. They think, oh, it's an ETF, it's a fund, so I must be diversified. It must be really easy, low volatility. Well, no, just pull up a bloody price. You can find this on Yahoo if you wish. Okay, it's not a problem. You can find it there, right? So what else have we got on here? We've got quite a lot. I still want to go. That's the movement of it, by the way. And this is something else which causes people to panic. Look at that. It was down 7%, down 3%. I told you 2018, when my son was born, the last 3 months were bad in the markets generally. So this was highly correlated to what was happening in the rest of the markets. And you might go, oh, but bloody rubbish. It's down 7% in a month, then down 3%, then down 4%. My God, I'm going to panic. I'm getting out of here. Oh, next month it goes up, but still, I've not made my money back. No, 6 months, I've not even made my money back. I'm bored. And yet we know that's what it looks like. So you've got to allow for human nature and the fact that you might not be able to execute upon an idea. Like, I've got an idea. Let's go to the gym every day, Alpesh, you'll be healthy. Yeah, but I'm really crap at executing on that. So it's not that you lack the idea, you lack the execution sometimes. Sometimes you made the decision-making too complicated as well. So that's why we're simplifying both of those things. And that's part of my job, to make sure that we show you the simplification, not just, hey, go buy this. Looks great. I can give you a bullshit narrative about it. And Europe and momentum. Oh, European defense spending is going up. Europe isn't America. Therefore, it's a diversification against tech. As you can see, there's momentum within there. Blah, 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 blah. Okay, what I found has been probably the best indicator is if this little beauty, the monthly MACD is rising, I probably want to be in. If it's falling, I don't. Don't use that as a strategy. You're not a trader. You'll go on holiday, it'll fall, you'll miss it. Or you'll get bored along those periods, or you will panic. Boredom, panic. How do you avoid those? Well, you could try self-discipline, or you could say, you know what, it's part of a portfolio, I don't need to worry. Because in a portfolio of 20 securities, this is just one. And as it rides through the cycle, it'll go through these cycles and it'll make up for it. Very rarely do things go just up and up and up. I'd say one of the rare things, a couple of rare things in my portfolio, which have only gone up and up and up pretty much for the last 6 years, are McKesson and AutoZone. Okay. Meta, Microsoft, Apple, Amazon, Alphabet, Goldman Sachs, JP Morgan haven't gone up and up and up and up. So what's suitable for one person isn't suitable for another. Some will panic at this, which is why we like to show historic monthly returns. Others will get bored at no returns for a prolonged period of time. And therefore they'll miss out on the bigger returns, which is why often people need hand-holding. Yeah, unfortunately, what they do is they go into the hands of an IFA or wealth manager who will F it up anyway for them. I'll explain to you why in a second. So that's it, the stoic. That's what you're looking for. That's what you're looking for. Okay? Can you see that? And that'll make you richer than anything else. You're also looking to put it all into a portfolio. Why into a portfolio? When you put something into a portfolio and look at it at a portfolio level, as I showed you earlier with the chart of two investments, A and B, the drawdown should be shallower. Okay, don't look at this return. That could be just curve fitting to history. That'd be really bad. We're not back testing anything. This is not back test. That'd be stupid. The stupidest thing in the world you can do is just back test. Oh, how did it do? Well, that's easy. Why don't you just buy Monster Beverages? That's the best performing stock in the last 20 years. Okay. Well, on that basis, that's back tested, Alpesh. Great. I'll buy Monster for the next 20 years. Well, I'm not so sure. Okay. Don't do it. The point is, we're looking at the thing that's worth back testing is how did they all perform in terms of drawdown? Okay. So whatever stocks you put together, this is one that we created for a client or a portfolio to see that. We then show them what happens if you don't, if your behavioral systems are such that you don't ever get out, you just held it through the worst falls like 2022 as well. So you can see there's individual stocks here. So each one of these columns is a stock. Okay. Okay. And you can see some of them here, some names there. All right. Each one of these is a stock. And you can see there was never one period where every stock had a win year. There was periods where I think virtually every single stock dropped at least double digits or near as damn it to double digits. Okay, I don't think there's any stock which hasn't dropped double digits and hasn't had a negative year. And yet, we also know that's what 32% looks like, which is ridiculous. If we get that in the future, we're over the moon. We leave a margin of error of 50%. 50% margin of error. So if we get half of that, then that's still doubling your money in 5 years. So $1 million becomes 2 million in 5 years, and in 10 years, it's 4 million. So in 10 years, $1 million has become 4 million. And in 15, it's become 8 million. If you do half of that, all right? And by the way, half of that, I'm pretty sure we could, because that's actually the longer term average. Well, the last 12 or the 15-year average of the US markets anyway. So all I just said to you in a very convoluted way is, if we just match the market with the individual stocks and not paying fees to any IFA or wealth manager or fund manager. But why won't most people do that? Because they'll panic and they'll get bored. They'll try and time. Okay. they'll overtrade, they'll get in at the top, they'll panic and exit at the bottom, and they'll get bored and exit too early. That's simple. I've just told you everything you've already done. I guarantee every single one of you has made that mistake. I know you have, because all the data and the research shows you will have done. Otherwise, you wouldn't be on the webinar, right? Otherwise, you'd be working for me. There you go. That's the returns. And that's the reality. And if you don't show people that transparently, then they can't do it because they will panic and get bored. And let me tell you what one of our jobs is not. This is 2025's top London Stock Exchange listed stocks, the top 20 performers, 4,000%, and the top American performers last year. Our job, let's just be absolutely clear, is not to pick these. I don't mean purposely. I mean, we're not in the business of trying to pick one or two big name, knock it out of the park. That's a fun game to play, but it's not a sensible pension-related one. So if you want to know why pensions are underperforming then, Alpesh, why are IFAs and wealth managers getting it wrong? Why do they undertrack? It's because, as I've often told you, not just the high fees, but we know from the data, and we know from Eugene Femer, who got the Nobel Prize, we know the reasons why they underperform is because they're picking from a narrow gene pool. You can pick from all 10,000 stocks and narrow it and filter it down. They can't, because they have so much money to invest, or they're mandated only to pick UK stocks. So that's basically 100 companies. There's anything outside the FTSE 100. There's relatively few funds that can invest in it anyway, because they're too big and the companies are too small. You'd end up taking them over, right? Let alone trying to exit in a year like 2022, where we have a very simple rule. If we get that, which some of you will know what I call the daddy bear, where the green falls below the blue, in other words, the short and medium term prices are both declining, we probably want to be holding cash. Not if it just happens in the S&P, but if it happens across a whole bunch of key stocks, then we probably want to be exiting, okay? This is from Goldman Sachs Asset Management. So it's what the rich people do. Goldman Sachs Asset Management. Most people say this is too conservative. Years to retirement, say you've got 25 years, you have 90% in equities. I've got 90% in equities. A fixed income is bank account, 4%, 3.8%, I think is the best interest rate you can get at the moment in the UK. If you're watching this in America and New Zealand, it's sort of same principles as this. This is very, I copied this from Goldman Sachs because it's not actually particularly controversial. It's not very bespoke, but it's not particularly controversial. Okay, now I want to show you something else. I want to show you the news right now, and let's have a look to see if there's anything in here. Wow, UBS turns bullish on Palantir. Why don't I care? Well, it says buy the dip on this clear AI winner. Well, because there isn't actually a direct correlation between UBS's buy sentiment and a stock moving up. What there is a correlation is if Palantir happened to be one of the ones which was all green on here, and we needed to then narrow down by which major bankers recently upgraded them, then we might pick Palantir. But that's because it hits all the numbers, not because of the headline. Now you know why you can ignore all these headlines. And somebody like Warren Buffett says, yeah, I watch all of this, but I don't really do much about it, because he doesn't need to do much about it. There isn't much to be done. You've got a portfolio, you hold on to it. Big tech and banking stocks up. Norway's 2 trillion wealth fund book, 250 billion. Yeah, no kidding. That's pretty good. 2025 was big tech and banking. As you will know, I own JP Morgan and Goldman Sachs, and you'll know Goldman Sachs was up about 60% last year and JP Morgan about 40%. Big tech, Nvidia was up 40%. What was my worst performer? I don't know. Microsoft was down last year. Can you believe it? So what? I didn't put all my eggs in Microsoft. Although I normally joke at the start of every year, maybe I should just buy Microsoft, nothing else. Well, thank God I didn't do it last year, which was proof why me saying, hey, what happens if we put all eggs in one basket? Don't do it is actually right. Don't do it. Stocks, sell-offs today, slides 400 points. Am I bothered? No. When will I be bothered? Well, if the monthly MACD, the green one, starts falling, then I might say, oh, we're going to get a 14% drop at some point today. This year. What does 14% look like at current levels? It's about this. That's going to happen this year. Why? Because statistically it tends to, did it happen last year? No, last year was 21. So I'm going to say 14% at some point this year. Statistically, it happens. Oh, what if we dodge a bullet, Alpesh? We don't get it. Well, then you're hardly about to complain. Oh, Alpesh, we didn't lose as much money as you said we would this year. Okay, so that was 8. What was this one in the past? So all I'm saying is brace yourself. It'll happen at some point this year, I think. And if I'm wrong, you're going to be happy because you're going to say, oh, he was wrong about the falls. Great. We're all happy about that. Okay, if it happens. What else on here? And here's another one. India's economy grows faster than expected. Okay, and we get a lot of people saying, well, I want exposure to India just because they read a headline. Well, I'll tell you how you should look at countries instead. So you find the exchange traded fund for something like India. All right, so let me show you, and I've done it here. There's India. You've got the exchange traded fund. I think I've shown you this before, and that's where it is. Oh, we're not getting the returns, are we? There are some periods when it is, and there are many which aren't. There's the MACD monthly. If this is rising, then you can consider getting in. But be careful, it's not guaranteed, because look, it was starting to rise there, and then the country did nothing. Okay? If this is falling, then you want to stay out. And that's a good rule, generally. Okay? And when you look at it, you think, oh, shit, hey, all these headlines are not translating into money. India is currently, March 2026, it's at the same levels it was in September 2021. Yeah, pretty much. So for 5 years, nothing? So you might say, well, it's incredibly undervalued. You might be right. But Alpesh, my native DNA, I'm Indian, that makes me want to buy it. Well, fine, this is not the way to do it then, presumably. Maybe find something which is, but the MACD rule is probably as good as anything else to really cut through the noise, okay? Unless you want a PhD in macroeconomics, which even I don't have. All right, what about the ones which are moving? Well, largely because of stock-specific news, not the broader market. NVIDIA's earnings, anything to worry about? No. They made a shed load of profit. They got a profit margin of 75%. Okay. An Indian company is set to build $2 billion AI hub with NVIDIA GPUs. Right. Fine. Doesn't mean buying India will work. Pakistan, Afghanistan, it's not going to affect. US, Iran, if oil stays below $80, you're fine. Okay. So a lot of stuff goes on, a lot of news you can watch, but it has absolutely no impact on your movements in your portfolio. You just got to leave it alone and let Microsoft solve the problem, or JP Morgan. Dow futures tumble 500 points after hot wholesale inflation reading. Okay, so if inflation's rising, they might raise interest rates. If interest rates rise sooner than we expect, that is what caused the 2018 falls and the 2022 falls. So look for inflation. Is it likely to rise? And soon you will find that actually that's a headline which there's nothing we can do much about. And we don't know if inflation's going to continue rising, if interest rates are going to go higher. Remember, Trump's always screaming lower interest rates, lower interest rates. For those who are interested in all the tools that I mentioned, they're all free. campaignforamillion.com/tools. You can rate your pension here. There's the pension rater. We've even got one where you can upload a photo of yourself. It'll then guess your age, or you can put your age in directly anyway. So it's a bit of fun. And then it'll tell you how many years you've got, how much till retirement, and typically how much people have at your age, and so on. And then you can see a whole load of videos here from TikTok, 1.9 million likes. Must be doing something right. Almost 500,000 followers. And from my YouTube channel as well. Okay. On those two, I'm going to answer some questions now. I've gone through things pretty quickly and mentioned the AI thing. I mentioned AI specific stocks. I've mentioned individual securities as well. I'm going to see if I've missed anything. For those interested in particular in the program and want the hand-holding and the mentoring, and it's 0.1% of you, which is perfectly fine, then you probably fit into one of these 6 categories. Feel free to put into the chat which one of these you are. You know, are you the businessman who sold the business, is building a legacy for children? Are you frustrated with pension growth? Are you the DIY investor who wants all the data and the work done for them? Are you the professional who hasn't got the time and is fed up with 5% from St. James's Place, or the late starter, or just the independent thinker who wants to manage it themselves? Whichever one of those you are, let me know as well. I'm going to answer some questions for you all now as well. And share some files with you, including the book, Investing Unplugged. I'm going to share the Investing Unplugged book for you as well, and a press release we did about some of those free tools that we've got for you. So let me go into the chat. Okay, can you clarify the indicators you are looking at, please? Yeah, let me just show you something. Okay, I'll do even better than that. And I've put it in my books as well. You don't have to buy the books, but I have put on there right now one of the, give me a second, I'm going to just show you. I'm going to have to put where it's free. Okay, hopefully it'll come up. Oh, for the love of God. Yahoo Finance used to be good. Here we go. Yahoo Finance, which is free. Okay. So if you're going to do it free, you go to Yahoo Finance. Okay, finance.yahoo.com. You put in a particular thing, and you'll be able to, on the charting, there you go, put on a particular indicator. But please don't now start trying to use that MACD there to see bar, chart, okay, period, play around with it. Don't now think, oh God, I'm going to do that, Alpesh, and I'm going to start trading and set up my own hedge fund. No, you're not. Okay. You can put logarithmic if you wish, doesn't really matter. You put that chart on there. When you go into chart, there should be something somewhere which just shows you how to do it. But it's all free on there, which is quite good. Interval, I prefer monthly if I'm investing because it gets rid of more of the noise, and then you can always zoom in by scrolling in. See? Okay, and there it is. There's your monthly MACD. Bang. Right there. There's other statistics. This will just make you procrastinate more. But it is good. I mean, yeah, the stuff that they give you, it's all completely for free. All right, then you got all that statistics, and then you'll start thinking, wait a minute, it's giving me the statistics. Oh, okay, if it's this, wait a minute. Are you going to go through 10,000 companies? And how do you know PEG ratio is more important than price to sales or price to book? Price to book, by the way, is what Warren Buffett prefers. But the data suggests that trading PE might be more accurate in absolute. So unless you know all that, value, growth, income, cash flow, Sortino, you might end up looking at the wrong factors. And if you're not going to look at 10,000 companies, then what happens? All your Sundays have gone. And look at this lovely beauty from the P&L, the balance sheet, and the cash flow statements. Even more data. Oh, great. Now you're thinking, screw it, I'll just give it to somebody. Well, do you think that somebody you're giving it to is going through all this data? No, they're not. Do you think they've got this? No, they haven't. They're an IFA whose job it is to sell you a fund. Do you think those two fund managers are going through it? Through 10,000 companies? No, because they've been told they can only pick from 100. So you know what the average fund manager does? He goes, the benchmark's the FTSE 100. Let's look at the FTSE 100 components and let's overweight on some of them, underweight on others, and hopefully that'll mean we outperform the benchmark. Great. And if the benchmark falls, you're screwed. That's fundamentally why they F it up. Most of the time, that's why they mess it up, full stop, all the time, these people. So that's how we do it. We get the data. We look at what we know from the academic research and the Nobel Prize winners and Goldman Sachs in terms of Croakey and the hedge fund industry is important. And then we try and encourage people to look at portfolio level. Because what we found is when we were told them at the stock level, and obviously portfolios are based upon individual stocks, it gradually occurred to us, people are getting panicked on an individual stock when actually they should be calmer looking at the portfolio, which is what Warren Buffett says. So we emphasize the portfolio a lot more now. It's just a behavioral nudge we give them, a behavioral nudge. These are the objections you hear every week. I'm too busy. I can do it myself. I'll get it wrong. My provider will handle it. I've been burned by exes before. But essentially, as I said before, you don't need more time. You need fewer decisions. You need the data. You need the transparency. You need the handholding. And then you need the portfolio. And then you leave it alone. You leave it alone. You're not there to trade, and you don't want somebody else trading for you. You don't want somebody charging you fees every day, every week, every month, which is what these bloody fund managers do. In fact, fund managers are the worst. IFAs are the absolute worst. Fund managers come second. You're probably the closest as somebody doing it yourself, having more going for you than anyone else. Sorry, I don't know why I put broker independent. That should be a tick. Should be ticks under DIY. With the exception of the first two, the other three. These two should be green ticks. They should be green ticks. Okay, these two should be green ticks. I'll change that. Okay. So you're close. You're the closest. You get better than fund managers who aren't broker independent. They don't do it bespoke. They can't select from global stocks. They've got to select from whatever remit they've been given. If it's Vietnam, etc. Okay, they only have access to their own research because they're told only use your own research. I face zero words. They've got bloody nothing. Okay. And that's what I want to do. Any other questions? Let me just check the questions. Warren Buffett allocates for a concentrated portfolio of 3 to 6 high quality, understandable businesses. Do you agree? I don't have a problem with that. As long as you've got, well, actually, he doesn't have 50% of his capital is in 6 companies. Now, that's suitable for him. It's not suitable for you. I can guarantee you that, because the volatility that implies is not something you would be able to handle. You'll panic. Okay, so I'm not trying to be Warren Buffett. Equally, you're not trying to be me. So what's suitable for him and what's suitable for you is different. In fact, I'll show you what's in his portfolio right now. And not only will I show you what's in his portfolio, I'll show you what's in Goldman Sachs and Bill Gates. There you go. There's the Buffett portfolio, and the top 5 holdings have 50% of his capital, but he's got about 40 individual securities, but some of them are small holdings. So would I do the same? No, for a start, I wouldn't want American Express or Coca-Cola because I've got other companies. So why does he have them? Because he bought them in 1963 and got massive dividends from them, which is the right thing to do. If you bought it in 1963, then I would continue holding that much of it, because the dividends yields I'm getting from the billion shares I have in them are phenomenal. Guaranteed income, because you know those companies are always going to keep paying dividends. So you don't have an issue there. Would I have 25% of my portfolio in Apple? No. Most I've ever had in Apple is about 15% of my portfolio, but I don't want to put that much into Apple, not least because I've got Nvidia to find room for, and Microsoft, as well as Meta, Alphabet, JP Morgan, and Goldman Sachs. Does that mean I'm wrong and he's right? No, I think if I could, with the billions he's got, get his returns, I'd be a bloody genius. But luckily, I don't have his billions. So it's a lot easier for me because I've got a bigger group of companies to choose from. He's got a very narrow group, so he's exceptional that he can do this. And actually, if I had the quantity of money he's got and started in 1963, yes, that's the portfolio I'd want, because I'd have massive dividends from the best dividend payers, Coca-Cola, American Express, and I'd have liquidity because I can't buy other companies. So that is what it would look like if you started in 1963. But if I was starting today, no, I think I'd probably want Nvidia, JP Morgan, Goldman Sachs, some of the others in there. And I wouldn't want 26% in Apple alone, which I think is fairly reasonable to say. I'm not trying to beat him or not beat him. I'm trying to find what's suitable for me and my volatility at the portfolio level. And I'm not saying he's got it wrong. He's got it right for the amount of money he's gotten from when he started. It's self-evidently exactly correct. If you started in 1963 and I had a time machine and somebody said to me, right, you got to find a stock and you're allowed to hold it for the next 40 years, I'd say, give me Coca-Cola and American Express. I'm sure I would. So that's where we go. So really, any available to no fan, I just showed you. It's all available for free. There you go. It's on. This is free, yeah? Yahoo Finance is free. All those tools are free. Campaignfor1million.com. This webinar's free. Fan. Okay, down. Warren Buffett advocates. There we go. Gavin, regarding the original quality 5, in the past you said the idea of coming out when the MACD. Yeah, you can either get out because you're panicked or you're worried and you're risk averse, so you can exit, or you can stay in and do nothing and hold it as part of a portfolio, or you can buy a dip, but only with good quality companies. So you've got 3 choices based on your risk appetite. If you're on time appetite, if you've got very little time, you just stay and hold, obviously, because you've got very little time. If you're very risk averse, you'd get out and might buy back more expensive later if it has a V-shaped recovery. And if you're more risk loving, you'd buy more on a dip. So you'd work it out based on your appetite. But if you think the answer is you use a time machine, you're wrong. Okay? Because you don't have a time machine. All right. I'm late starter regarding 46, 42,000. So I'm aware I'm up against it. Gavin, have a look at the free tools on campaignforamillion.com. Fan, have a look at campaignforamillion.com /tools. You'll find some really helpful tools. They're all free and they're free forever. You don't have to give your email address even. Okay. On those regarding the quality. Right. I think I've done that. No, best way of learning how to read charts, please. Don't read charts. The charts, you're going to start trading if you read charts. And you're getting it the wrong way around. You're seeming to think if I read the charts, then I will make lots of money. I've already told you, I've given you the lesson. That's it. Okay, that is it. That's the best way. I've just shown you. If the monthly MACD is rising, you're in. If it's falling, you're out, but only applies to ETFs. And don't trade. So don't use it to trade. Okay, but this often happens. People misinterpret this and think, shit, he's just giving me a strategy to trade. Now I'm going to be a trader. It's like me showing you the Virgin Gym and you thinking, great, I'm going to have a six-pack now because I'm going to go to the gym every day. You're not going to do it. Don't try and do it. It's not going to work. I guarantee it. Okay. The reason I showed you is to give you an interpretation of what's going on at the moment. You have a portfolio of good quality companies and you hold them, just as Warren Buffett does or Bill Gates does, or Goldman Sachs do. And I've named a whole load of ones already on here and given you the information of which ones I happen to like at the moment. And I plan to hold them for a long period of time. So it's not like, oh, that's just for this week. It's not for this week at all. Are you buying Microsoft right now? No, not right now, because I already hold it. And who did graphics on your slide? Best selling average slides. Can you clarify the indicators? Okay, cool. I think we're all done. I try and keep these under an hour, which I've managed to do so far. The program's only for the 0.1% who want total handholding and want all the data and everything done for them. If you don't, you just get the quality companies, some of which are mentioned. What a major lesson is, sit, ISA, do it for yourself. And hold for yourself and use the free tools on Campaign for a Million to work out how much you should hold in cash and what the volatilities could be. Those free tools, okay, will calculate for you how much money you need, how much you've got, all right? Because these are the other things. They're all free. I'm going to say it again. This is free on campaignforamillion.com /tools. It'll tell you how much you need, how much you've got, okay? It will also tell you how much you can withdraw, okay, and what the risks are. And as you go, look, one page, and you can play around with it all you want, all free, campaignforamillion.com /tools. It'll also tell you stress test a portfolio. So then the next thing is, well, actually, how much should I have in a portfolio? Really simple. How much should be in a portfolio? There you go. Okay, based on your age, how much should be in cash? How much should be in stocks? How many stocks? 20 to 40. How much in each? Equally weighted, 2.5% to 5%. Now your decision is simply which companies. Well, I've happened to name some of them. Well, wait a minute. How do I know if it's too volatile for me, Alpesh? There you go. There's the volatility number. Assume 15% volatility. But how do I know what it's going to be like in a really bad year, Alpesh? Actually, that'll stress test it for you and show you, well, what would happen in a bad year so you don't panic. What you're wrongly trying to do is give me some stocks which will work for this week, this month, and then tell me again next week which ones. We're not a stock tipping website because we know from the Nobel Prize winners that does not work for people. It does not work. And if you want some more free education, there's a whole bunch of free, if you go to alpeshpatel.com/shares, there's a whole bunch of free stuff you can look at on here as well. See where it says preview, all of these are free and it'll teach you quite a bit there as well. Okay, it'll teach you quite a bit there. If you really want to learn about the charting and really don't trade, you're going to mess it up. You are absolutely going to mess it up. Okay. I did one a while ago for the traders and it's free. Okay. So if you want that free education, it's trading-champions.com. It's free. Okay. And it's trading and it's to show you what trading involves. Okay. It's completely free. And it includes, so it's trading-champions.com, and it does include a whole bunch on charts as well. But really don't do it because in my experience, private investors F it up when they think they're going to trade. This is not about trading. It's about buying and holding some good stocks for a very long period of time. For the few who want it all done for them and hand-holding and want the data done for them so they don't have to go into, Yahoo Finance or whatever, that's what this is, fan. It's for the 0.1% who don't want to do it themselves. That's what I'm talking about, who don't want to go to, as I said, Yahoo Finance and read all of this and blah, blah, blah. Okay, who feel that they might make the mistakes of looking at the news and then trying to stock pick and time the markets and all the things I said don't do. And instead, they want a mentor who's going to slap their wrist every time they F it up. Then that's for them. Then the program's for them. But for the vast majority, you'll say, no, thanks, mate. I'll just try and do it myself. Thank you very much. And that's perfectly fine. Please do. But if you are, then please remember you're buying and holding a good set of quality companies. Leave them alone. Don't panic. Don't get bored. Don't try and trade. Don't try and time the market. Don't try and be right on every single stock pick. Don't worry because you've only got 2.5 to 5% in any one holding. Do leave some for cash. The older you are, the more in cash. Look at those free tools of how much cash you should hold. That's all there. You can do that if you yourself. This is not a tip sheet. It is not a tip sheet of, oh, buy this stock now. This week it's going to go up and this is going to go up. We can play that game, but Eugene Faber, the Nobel Prize winner, shows that you'll end up losing money trying to play that game. It won't work for you. So don't do that. Okay. So those are the most important lessons. And I've also mentioned to you on the AI front, the companies, some of the ones that we happen to like at the moment, but we wouldn't put it all in AI because that'd be all eggs in one basket. Equally, we don't think the market's overvalued and it's about to crash. And the main thing I look at is the momentum indicator, but I don't trade off it. I look at it to determine where we are. 99% of the time, I have to do absolutely nothing because it's for Lamb Research to make me money. It's for JP Morgan to make me money. Not for me to have to go out there and do it. If you get time, please reply to my email. Eager to get investing. Yeah, Manu, I will. I'll check, of course. Let me know when you sent it. Self-managing my portfolio is flipping addictive. I know, well, that's the only thing. And this is how you would get gamblers. Oh, absolutely, David, 100%. And, you know, the good thing is you've recognized that, so you know not to fall into that. You know, if you look at what Warren Buffett does, he buys and holds and does nothing. But he spends all day reading, which is great. Or, you know, you could spend all day gardening, do anything. And if you need to scratch that itch, there's nothing wrong with it if you take, you know, £1,000 and go play Bitcoin with it if you wish. So with your pension and your portfolio, please, for God's sake, don't gamble with it and don't try and trade with it. That's my message. Sounds like, oh, Manu, okay, I'll have a look. That's weird. I normally get back in 24 hours. Get back in 24 hours. So thank you all very much, everyone. And do have a look at campaignforamillion.com, okay? Because what you'll find on it is all those free tools. And we made them free so you got all the work around your portfolio. You see, it's one thing to say, here's 20 companies or funds. Here's your portfolio. Here's your cash. But wait a minute, how much do I need? Do I have enough? What do I need for retirement? How much can I safely withdraw? How long will it last? What if I live this long? What if the market has a crash and there's volatility? What does it look like? That's what all the apps and tools do for you, everything around it, all the questions you might have. And the great thing about tools is we don't even ask for your email address and you can play around with it for as long as you want. It's all free forever. It's not like freemium where you do a few versions and go, oh, please pay this to do more. It's completely free. And then you might do one for your wife, your husband, your son, your child, your daughter, whatever, your parents, and then go, oh, what if we did this? What if we did that? What if we did this? All completely free on campaignforamillion.com. And those 7 apps we got created for that reason, that we thought, you know what? All these companies keep putting on places like LinkedIn. This is my LinkedIn account. Do follow me on LinkedIn. They put on there, you know, you'll see adverts come up from Fisher Investments or St. James's Place. How far can 500,000 go in retirement? And we said, well, screw that. We'll just create you the tool which works it out for you. Okay. And it's a better tool than they've ever given. And they certainly don't give anything for free. So what we say is, here's the tools for free, campaignforamillion.com/tools. And it's bloody brilliant, actually. What you'll find on that website, it's a really good website, actually. I'm going to let you into a little secret. See all these free tools. Those are all free on there, on campaignforamillion.com. The latest webinar, why the pension's performing poorly, etc., etc. But there's the blog. Okay, the blog. Okay, there was an article just a couple of days ago, and there's some which I've sort of pinned. Okay, and these are really good. There was one 3 days ago, 4 days ago. I try and do one a day approximately. So that's like 1, 2, 3, 4, 5 in 7 days. Okay, not quite one a day. Oh no, there you go. 6 in 7 days. 7. Yeah, 7 in 7 days. There you go, roughly. So there's quite a bit. So, if you do want to learn a little bit at a time, then that is a pretty good way of doing it as well. And it's all completely free on there as well. Okay, free resources. Here they are. And I've even got daily investment posts, all completely free. Got 4,579 subscribers on that. So if you go on campaignforamillion.com, you'll find all the free resources. And like I said, 99.9% of people will just use the free resources. Perfectly fine by me, which is why we have so many of them. And then the 0.1% will say, actually, can you handhold me, mentor me, collect the data for me, and look at the charts and everything else for me, and educate me and inform me and give me one-to-one tutorials and do it for me, which is perfectly fine, perfectly fine. Oh, thank you, Manu. Thanks for sending it again. It's all on the website, alpeshpatel.com/shares fan. It's all on the website. But all the free tools are on campaignforamillion.com, fan. Okay, it's all on the website. Okay, so I went through all of this just as an aide memoir, you will remember, and now I'm going to go because I have got another call. So I hope you found that helpful. And all the resources that we've created, the blog articles every single day. There's a blog, there's a free Telegram every single day post, and there's also all those free tools and apps as well. Hope you like it all. Okay, and it is very helpful, and it'll, together with this webinar and the most important things I've told you, it'll save you from making a lot of mistakes. And the common mistakes is what I wanted to share with you. People think it's all about, oh God, he said buy Micron. Well, yeah, Micron's in my portfolio, but only 2.5% of my portfolio. Does that mean you go and buy it? Well, what are you going to do? How do you know that's not too volatile for yours? So make sure you're looking at portfolio level. And it's not about one stock tip. I'm happy to hold that for at least 12 months. You might panic in 6 months unless somebody's telling you, don't panic. Okay, don't get bored. And the best way to do that is to make sure that you have a portfolio. But nobody ever tells you about the panic and the boredom. Warren Buffett does. Nobody ever bloody listens to him. Okay, people, thank you all very much. I got to go. Thank you.